JP Morgan just published their Q2 2026 commodities outlook. And buried on page 47 is a price target that should make every gold investor pay attention. $6,300 per ounce by December 2027. That's not from a gold bug newsletter. That's not from a precious metals dealer trying to sell you coins. That's from the largest bank in the United States, the same institution that manages $4.1 trillion in assets. But here's what makes this moment different from every other bullish gold call. 5 separate indicators that historically appear only at the beginning of major gold bull runs are flashing simultaneously right now. 5 signals, all at once. For the first time since 2001, and in 2001, gold was trading at $271 per ounce. Over the next 10 years, it rose to $1,920, a 608% gain. If we're at a similar inflection point, and JP Morgan clearly believes we are, then we're in what institutional traders call the final loading phase. The last window to accumulate before the move accelerates beyond retail participation. I'm John A.G. Let me show you the 5 signals and why this moment matters. But JP Morgan's $6,300 target is actually the conservative estimate. Later in this video, I'll show you what happens when you apply the same methodology they used, but update it with real-time physical market data. The number isn't $6,300, it's higher. I'll also reveal which of the 5 signals JP Morgan emphasized most in their internal client briefing, the one that wasn't included in the public report. When you see the full picture, you'll understand why major institutions are accumulating gold at prices most retail investors consider too high. Let me explain what a loading phase means in institutional trading, because understanding this concept is critical. Large institutions like JP Morgan, Goldman Sachs, and sovereign wealth funds can't buy assets the way retail investors do. They can't just log into a brokerage and click buy. When they want to accumulate a position, they do it gradually over months or years. They buy on dips. They accumulate during consolidation periods. They build positions before catalysts materialize. The loading phase is the period of accumulation before an asset breaks out to new highs. During this phase, price moves sideways or grinds higher slowly. Volatility decreases. Retail interest fades. Headlines shift elsewhere. But underneath the surface, institutional buying is persistent and systematic. The 5 signals I'm about to show you are the indicators that institutional analysts use to identify whether a loading phase is ending and an acceleration phase is beginning. When all 5 appear simultaneously, it historically marks the transition point. The window before price moves faster than most investors can react. According to JP Morgan's analysis, we're at that transition point right now. Welcome to Macro Shield Method. I'm John A.G. If you're new here, hit subscribe and drop a like. This is the institutional level analysis that helps you position alongside smart money. Help me spread it. Now let me walk you through the 5 signals. Signal number 1, central bank buying has exceeded absorption capacity. Central banks bought 1,234 metric tons of gold in 2024. That's the highest annual total since 1967, and 2025 is tracking 18% higher through Q1. But here's the critical insight from JP Morgan's report. Annual gold mine production is approximately 3,100 metric tons. Central banks are now absorbing nearly 40% of annual production. When you add jewelry demand, industrial use, and investment demand, the math doesn't work. Total demand is exceeding total supply by approximately 300 tons per year. That deficit has run for 6 consecutive years. JP Morgan's analysts note that in previous cycles, when central bank buying exceeded 30% of annual production for more than 3 years, gold prices doubled within 36 months. We're now at 40% for 6 years. Signal number 2. Real interest rates have failed to suppress gold. This is the signal that broke their traditional models. For decades, gold had an inverse relationship with real interest rates. When real rates rose, gold fell. When real rates fell, gold rose. That relationship has decoupled. Real rates have been positive and elevated for 18 months. Gold should have fallen or stagnated. Instead, it's risen 34%. JP Morgan's report states explicitly, the historical relationship between gold and real rates has broken down, suggesting a structural shift in gold's role as a reserve asset. When your model breaks, you don't ignore it. You recognize that something fundamental has changed. Signal number 3, the gold to S&P ratio has reached a 50-year extreme. Gold is currently trading at approximately 0.48 times the S&P 500 index level. That ratio has ranged from 0.18 to 4.2 over the past 50 years. At 0.48, gold is near the lowest relative valuation in half a century. In 1980, the ratio peaked at 4.2. In 2011, it reached 1.3. Current levels suggest gold is extraordinarily cheap relative to financial assets. JP Morgan's historical analysis shows that when the ratio falls below 0.5, Gold outperforms the S&P 500 over the subsequent 5 years in 94% of observed periods. We're below 0.5 right now. Signal number 4, physical premiums are structurally elevated. Premiums over spot price for physical gold products have averaged 7.2% over the past 6 months. Historical average is 2.8%. This isn't temporary tightness. This is structural premium elevation that indicates persistent physical shortage. JP Morgan tracks premiums in 14 markets globally. 11 of 14 are showing elevated premiums. Only 3, all in Western markets with heavy ETF influence, show normal levels. When physical trades consistently above paper, the paper price is understated. Eventually, paper must adjust upward to reflect physical reality. Signal number 5, mining industry capital expenditure has collapsed. This is the signal their internal briefing emphasized most. Gold mining capital expenditure peaked in 2012 at $23 billion annually. It's now running at $8 billion, despite gold prices being 50% higher. Mining companies aren't investing in new production. Discoveries have collapsed. The average time from discovery to production is now 17 years. JP Morgan's supply analysts project that gold production will decline 15% by 2030, regardless of price, because the investment wasn't made when it needed to be. Demand growing, supply shrinking. For the next decade minimum, those are the 5 signals, all present simultaneously, for the first time since 2001. Now let me show you what's happening in the physical market that supports JP Morgan's thesis. Shanghai Gold Exchange withdrawals hit 1,247 metric tons in the trailing 12 months. That's 40% of global annual production absorbed by one exchange in one country. The People's Bank of China has added gold to reserves for 18 consecutive months. Officially reported additions total 316 tons, but import data suggests actual accumulation is 3 to 5 times higher. India imported 892 metric tons last year, despite high domestic prices. Traditionally, Indian demand falls when prices rise. That relationship has broken. Central European nations, Poland, Hungary, Czech Republic, have increased gold reserves by over 100 tons combined since 2022. These aren't traditional gold accumulators. They're converting euro reserves to gold. The Middle East is accumulating aggressively. Saudi Arabia, UAE, and Qatar have all made reserve additions that aren't fully reported, but are visible in trade data. Every region, except the United States and Western Europe, is accumulating physical gold at elevated prices. And here's what connects this to JP Morgan's $6,300 target. Their model prices gold based on central bank demand as a percentage of reserves. Current central bank gold holdings represent approximately 17% of total reserves. In 1980, that percentage was 55%. In 2000, it was 35%. If central banks return to 30% allocation, not even the 1980 level, gold must rise to approximately $6,300 to accommodate the demand within available supply. That's not speculation. That's the mathematical relationship between allocation targets and available metal. And based on the buying patterns they're tracking, JP Morgan believes the 30% allocation target is increasingly likely. Now, I need to explain something ironic about JP Morgan's bullish call. This is the same institution that paid $920 million in 2020 to settle charges of manipulating precious metals markets. The same trading desk that has held massive short positions in gold and silver for decades. So why are they now publishing $6,300 targets? One possibility, they've already positioned. The trading desk accumulates first, then research publishes bullish analysis that attracts buyers to push prices higher. Another possibility, the manipulation game is becoming untenable. When central banks are buying 40% of annual production, when physical premiums are structurally elevated, when every model breaks, the ability to suppress prices through paper contracts diminishes. Look at what happened in silver in January. Price spiked to $121 before a coordinated margin increase crashed it to $64. But within weeks, price had recovered most of the decline. The interventions are becoming less effective. The rubber band snaps back faster. And there's competitive pressure within Wall Street. Goldman Sachs published a $4,200 target last month. Bank of America has a $3,800 base case with $5,000 bull case. Citi sees $4,500 within 18 months. When your competitors are publishing bullish targets and accumulating, you can't stay bearish publicly without losing client assets to rivals. The Wall Street consensus is shifting. JP Morgan's $6,300 isn't an outlier anymore. It's the leading edge of a consensus that's forming. Now, I need to be balanced here, because that's what we do on this channel. JP Morgan's $6,300 target has a December 2027 timeframe. That's 18 plus months away. A lot can change. Here are the risks to the thesis. Risk 1, central bank buying could slow. If geopolitical tensions ease, if dollar confidence stabilizes, the urgency driving accumulation could fade. Risk 2, Mining supply could surprise. Higher prices could accelerate production from existing mines or restart mothballed projects faster than expected. Risk 3. Paper markets could continue functioning. The disconnect between paper and physical hasn't broken the system yet. It might not for years. Risk 4. Alternative monetary technologies could emerge. Central bank digital currencies, crypto evolution, could reduce gold's monetary premium. These are legitimate uncertainties. However, here's my assessment. The 5 signals JP Morgan identified aren't short-term fluctuations. They're structural changes that developed over years. Central bank buying patterns don't reverse quickly. Mining underinvestment can't be fixed quickly. The gold-to-equity ratio doesn't normalize quickly. The direction is clear, even if the timing is uncertain. And history shows that when institutions like JP Morgan publish targets this far above current prices, they've already accumulated significant positions. Let me explain what happens to investors who wait for confirmation. When gold broke $1,000 in 2008, most retail investors thought it was too high. They waited for a pullback to $800. The pullback never came. Gold went to $1,920. When gold broke $2,000 in 2020, the same pattern. Too high. Wait for pullback. It consolidated, then went to $2,900. Every major level creates the same psychology. It's gone too far. I'll wait. But institutional accumulation doesn't wait. Central banks aren't timing the market. They're systematically converting reserves. They buy at $2,900. They'll buy at $3,500. They'll buy at $5,000. Their demand is structural, not tactical. If JP Morgan's $6,300 target materializes, current prices around $2,900 represent a 117% upside. But if you wait for confirmation of the move, you'll be buying at $4,000 or $4,500, cutting your upside in half. The final loading phase concept exists precisely because it's the last window before price moves faster than hesitant investors can react. Every institutional bull market has this phase, the sideways grind that shakes out weak hands before acceleration, the boring period that precedes the exciting period. That's where we are now. The boring part, the loading part. The exciting part comes later, and by then the loading phase has closed. Let me show you what happened the last time all 5 signals appeared together. Gold at $271. Central bank selling had finally stopped after years of liquidation. Real rates were falling. Gold to equity ratios were at extreme lows after the dot-com bubble. Physical demand was steady. Mining investment had collapsed during the 20-year bear market. What followed? A 10-year bull market. $271 to $120, a 608% gain. The 5 signals didn't predict a short-term rally. They identified the beginning of a secular trend that lasted a decade. JP Morgan's analysis suggests we may be at a similar inflection point, not a trade, not a swing, a multi-year secular move driven by structural factors. If the 2001-2011 percentage gain repeated from current levels, gold would reach approximately $2,500. $6,300 suddenly looks conservative. Here's what I think is happening. JP Morgan's $6,300 target isn't a prediction. It's a positioning disclosure. They're telling you where they believe gold is heading so you understand why they're accumulating at current prices. The 5 signals they've identified, central bank buying, broken rate relationships, extreme equity ratios, physical premiums, mining underinvestment, these are the same indicators that preceded the 2001 to 2011 bull market. The final loading phase concept means we're in the window where smart money accumulates before price accelerates. This window doesn't stay open indefinitely. Goldman sees $4,200. Bank of America sees $3,800 and $5,000. Citi sees $4,500. And now JP Morgan sees $6,300. Wall Street consensus is forming. And when consensus forms, the move often exceeds consensus because everyone is positioning the same direction. The question isn't whether you believe JP Morgan. The question is whether you're positioned for the scenario they're describing. This is my analysis, not financial advice. Do your own research, make your own decisions. But the data is the data. JP Morgan, $6,300 target by December 2027. 5 signals simultaneously present for first time since 2001. Central bank buying at 40% of annual production. Real rate relationship broken. Gold to equity ratio at 50-year extreme. Physical premiums structurally elevated. Mining investment collapsed. The largest bank in America just told you gold is going to $6,300. They told you the signals are aligned. They told you the loading phase is ending. What you do with that information is up to you. Drop a comment below. Do you think JP Morgan's target is realistic? Too conservative? Are you accumulating here or waiting? I want to hear your strategy. I'll pin the best responses. Share this video with everyone who owns gold or is considering it. Most people don't know JP Morgan just published a $6,300 target. They don't understand the 5 signals. Help me spread this analysis. If you're not subscribed, hit that button now. I'm covering gold, silver, and the institutional moves that matter every day with analysis you won't find anywhere else. I'm John A.G. This is Macro Shield Method. Protect your wealth. Understand the system.